Wealth is a Choice podcast. Boom.
Let's listen to it. Let's listen to it.
All right, Kara, thanks for being with me today. I appreciate it.
Thanks for having me.
You are a master. I don't know, can I say the word goddess? You are.
I don't know. Goodness, that sounds really big.
You are a master at having people learn through entertainment. Like when I'm at a Kara Murphy economic talk, first of all, I'm having a great time, I'm being entertained, it's like being at a movie, and at the end of it, I'm like, damn, I learned something too.
I love that.
It's very cool. It seems supernatural. I don't know if it's natural to you or if you have put a tremendous amount of work on it, but damn, are you good at it.
I enjoy it. And I have to say, it's been a really fun kind of evolution, because I'm a total nerd, which I'm sure we'll talk about. But, I like pop culture and things too. And so being able to marry those two things and make what I think are really interesting but academic subjects accessible to people is just a joy. So I'm very fortunate that I get to be paid to do that on occasion.
That's awesome. That's cool. It doesn't matter what economic investment-related talk I go to, it seems that at the end of the conversation, somebody always says, and that's why we diversify. So, which I agree with diversification, but at the same time, it makes me wonder how important is it to how deep do people get into economic understanding, knowing at the end of the day we're going to diversify, and how much of that economic information actually drives investment decision, or we're just knowledgeable about the economy more than we were before, but we're still going to invest the same way?
So there are a few different layers to that. So I'll talk a little bit about how we think about it as a practitioner, right? So I spend my days watching the market, thinking about where the market's going, thinking about what's happening in the economy, and then building portfolios around it. So I have to have a very strong understanding. But then for a client, they really have a choice. They can get really deep in the weeds, and you and I will help them understand how all of these different things feed together to influence their portfolio and get them to their destination. Or there are going to be other people who are like, you know what, I don't really like this stuff, so I'm going to let you handle it. So as a practitioner, the direction of the economy is the most important thing that is going to influence the direction of the market.
Okay.
When the economy is growing, the market goes up, because companies are earning more, and then more of that goes to the end investor who's owning those stocks. That's on a very basic principle. And in fact, when I started on Wall Street 25 years ago, my boss and mentor at the time sort of drilled into me, don't fight the Fed.
Okay.
The Federal Reserve, the Federal Reserve drives monetary policy. Monetary policy, whether interest rates are going up or down, are the most important determinant of whether the economy is expanding, contracting. Therefore, the market really cares about it. So all these things are interconnected. That said, you can have an environment where, let's say, interest rates are going down and the economy is growing, but the stocks that you own are not doing well. That's really why you need to be able to diversify, because it's very hard to be able to determine not just exactly what the throughput is going to be of all that policy heading into growth, heading into how individual businesses are going to perform, but also to get the timing right. So sometimes you might be absolutely right in what happens, but it might take longer than you thought, or it might happen more quickly than what you thought. So when we put portfolios together, we like to think about the puzzle rather than the puzzle pieces.
Okay.
So there's a tendency to look at a portfolio and see, let's say, 20 holdings, and to zoom right in on that one that did badly. But the portfolio might be up. The portfolio might be doing really well. And we might be okay with that one position underperforming because, again, we know it's a puzzle. And we're not going to expect every single one to be working at the same time.
By the way, it's impossible. And there always will be one that did the worst. And there always will be one that did the best.
Absolutely. Absolutely. And
even if you just own two things.
Yeah, exactly. And if we focus too much on the top of that leaderboard and the bottom, then we're missing the whole picture. The question is, are we moving closer towards our financial goals or not? And the economy is a really important piece of that, but it's not the only one.
Okay. So you talked about some stocks might not be doing well and others could be. There's another saying I've heard for many years: "Is a rising tide raises all ships."
Yes.
And we did not see that. This is a weird era that we
Yes.
have just gone through.
Yes.
So that is more true more often than not. But with this AI development, we had a couple of years where there was literally just a very small segment of the market, which happened to be a huge market cap of the market,
Yep.
but a small segment of the market that did very well.
Yep.
And a lot, 1,000 some stocks that didn't do very well at all.
Yeah.
And there was nothing inherently wrong with a lot of those individual stocks. But this was not their environment. This was just Google and Microsoft and NVIDIA and whatever.
Right. And so and that's a great example where over the last 3 years, if you owned anything outside of the Mag 7,
Yeah.
it dragged down your performance,
Right.
right? And so it can be hard for people to look at it and why am I owning these underperforming things? I should just own NVIDIA or whoever the market leader is.
Right.
And the answer is because those market leaders can't be market leaders forever. It is
Right.
mathematically impossible. Otherwise, in a short period of time, you're going to have the Mag 7 who are multiples of global GDP, which intuitively just doesn't make sense. And I think the other thing to think about is like the fundamental reasons why the Mag 7 have done so well. It's because AI is this truly revolutionary technology. Something very different is happening, and that is very fundamental and is very real. That said, the more powerful that AI is, the more it actually revolutionizes our day-to-day, the more it will benefit all these businesses that are outside of AI. Transportation, energy, consumer discretionary, all these other businesses are eventually going to figure out how to incorporate AI. And that's the natural part of technological revolution. So as an investor then, you want to think about over the next couple of years as AI really expands, I need to own stuff outside of those Mag 7. So there's a real fundamental reason too why you're going to be looking for things outside of that area.
So I think having some level of economic understanding, even at a consumer level, can help you appreciate this was a strange era.
Yeah.
And things normally don't behave that way. And people can build some confidence and think that that's going to go on for a long time in a not normal era,
Right.
and then mistakenly think that that'll continue in that direction.
And this is like a well-documented bias that we as humans have. It is very natural. It's called recency bias.
Okay.
We want to look at the recent past and extrapolate and say, oh, the future is going to be just like it was over the last couple of years. And it is so common for people to do that. But if we know that we all have this bias to tend to extrapolate the recent past, then in your work, you can actually look at data then and challenge yourself. But what's going to change this? How should I be thinking about this differently in the future? And I think forcing yourself then to look at counter arguments, to look at data, to think through these scenarios. Is NVIDIA going to be larger than global GDP? These can help then counteract that recency bias and get you out of that trap.
I know. What's the market cap of NVIDIA right now? Do you know?
I should know.
Is it
It's over-
5 trillion something?
Yeah.
Something around, give or take.
It might even be 7. I can
give
look
or
it up.
take $500 billion. Yeah, I don't know.
Yeah, you know.
I don't know where it's at right now. But and I'd ask some people sometimes. It's hard to know where that's going to go, but is it more likely NVIDIA is going to get to 10 trillion when it's already twice the size of Germany's economy, or not? I don't know.
Yeah.
But so when did Enron collapse? Do you remember? I don't remember what year that
I
was.
want to say 06.
I think so, somewhere around there. But I had two events to me that redefined where I felt my level of understanding of the economy needed to be. One was the collapse of Enron, and then the financial crisis itself.
Yeah.
When we always believe that you don't have a portfolio where everything does horribly wrong at the same time. In the financial crisis of 08 was a credit crisis, and in the credit crisis, a lot of things fail.
Yeah.
And so it was those two events. The Enron one, because the understanding of all of that, how that came about, and some of the shenanigans being played with how companies were being rated and stuff like that. I'm like, oh wow, I can't just take things for granted from what an analyst is saying about a certain stock. Reminded me that I have to get a little bit deeper involved than I had been at the outer layer.
Yeah.
And then the financial crisis. believed that I needed to understand fundamentals better. And so I started downloading the Federal Reserve Flow of Funds reports, this huge document that comes out every quarter.
Yeah, when you probably had to have the paper, you had to print it out, right?
God, I print it out, and I'm looking, oh crap. So I had a friend at the Federal Reserve, and I said, what would I look at to understand the data better? And he said, the Flow of Funds report.
Yeah.
He's an economist at the Federal Reserve. That's easy for him.
That was right. That was fun for him. I print that thing up, like, what the hell am I looking at? And so I'd highlight a few things. I'd go down. We had a building in Detroit, the Federal Reserve building in Detroit. I'd go down. I'd meet with him. He'd explain this, explain that. It took me a little while, but after a while, I was able to find some pieces of data within there that I could keep track of that would at least give me some basic foundational level of what's going on in the economy. Yeah.
And then when I had that foundation, then when I would hear economists talk, I had a really good idea. Were they biased?
Put it all together.
Were they biased? Or like the Enron, were they biased?
Yeah.
Or not? And but it gave me a much better level of understanding in what was being said, and then what to take out of that conversation. So I realized, that was quite a while ago, that as a financial advisor, I have to have some level of understanding. So I'm kind of curious, as a financial professional, or as you manage a lot of money, directly, or as a retailer, what levels of economic education do you think is a baseline needs to be understood to be successful at each of these levels?
Well, and again, here's my bias. I think this stuff is so interesting.
Right.
So I want everybody to learn about it so that they can talk with me over cocktails. Okay. But and I'm a mom too. I have 3 teenagers, and so I also think about like what level of sort of financial proficiency and economic understanding do I want them to have? And as you can imagine, we talk about this stuff at the dinner table, and it's really fun to see things kind of catch on where they're making connections and whatnot. And I think pick any topic that's important in our lives. We want to be able to have a basic understanding to be able to, again, check our own biases and be able to fit our lives within that framework. And so most people are not going to need to know a whole lot about what CDO squares will do, right? It became an issue in the global financial crisis, but it was a very sort of niche product that most people today don't really need to be able to understand. But you need to be able to understand, number one, how important the Federal Reserve is. If the Fed is stepping on the gas and lowering interest rates, that's good for economic growth. If they're raising interest rates, that's going to slow growth. So I think understanding that connection is really, really important. Understanding how interest rates filter through the economy.
Okay.
Right. So as interest rates go up, credit becomes more expensive. Credit cards become more expensive. Auto loans become more expensive. Mortgage loans become more expensive, right? And that's the brake sort of hitting on the economy. And that will really impact our everyday lives, right? Decisions about whether or not to buy or sell a home are heavily impacted by where that interest rate is.
I think that's one of the ones that's very surprising, I think, to most people.
Yes.
It's hard to conceptualize from a mathematical monetary standpoint what a quarter point, a half a point, 3/4 of a point does to everyday life.
Yes, and it takes time to filter through the economy too. It's not like the Fed lowers interest rates and then all of a sudden we're off to the races. It takes time for new loans to be to be taken out, then for that money to be deployed, right? So, and that's why it can be frustrating because it's not like a switch goes on.
You can make that policy extremely difficult too, right?
Yeah, for sure.
You do something that's going to take months for that to make effect, and you should either also now be doing something again or not. And
that's why Federal Reserve officials are working with very imperfect information. I mean, they have access to more economic data than anybody, but it's still a moving target. And so that's also why they're often going to be very cautious. They're going to want to wait as long as they possibly can to make a decision because they don't know how previous decisions are still being worked through the economy.
Okay.
I would also add the labor market in there. So, understanding what makes labor looser or tighter, meaning is it easier or harder to be able to find a job? And I remember a couple of years ago, so this was end of 2021, so just coming out of COVID, and I don't know if you tried to hire somebody around 2021 or so, but it was extraordinarily difficult. It was the tightest labor market that we had pretty much had on record. And I remember we had a class of interns here, and they're all bright-eyed and bushy-tailed and looking for career advice. And I was like, guys, the labor market will never be as loose as it is today.
Yeah.
I can nearly guarantee you that 12 months from now, when you guys are all graduating,
Yeah.
it's going to be a lot harder to find a job. It may
Yeah.
not be super hard,
Right.
but don't count on it being like this, right? So
Yeah.
understanding that good times are great, but they're not always going to be like that.
Right.
And then last thing I'll mention in terms of like basic understanding of the economy is understanding where manufacturing is going. Manufacturing has become a smaller and smaller proportion of the overall economy, but it is still a really important engine. And so understanding where those new orders are coming in, where factories are still being built, what is that activity happening, is a really important kind of like a driver for the economy that doesn't get shut off very easily.
Okay. I wasn't going to ask you about this, but you mentioned manufacturing. This is something I'm very interested in. It's been declining since the 80s, right?
Yeah.
It used to make up like 30% of GDP. Now it makes up like 10% of GDP.
Yeah, it's just been in decline for
And
decades.
and right now, Trump is using tariffs as a way of implementing change. I read through Biden's national security strategy in 2022 and Trump's national security strategy in 2025. And what I was looking for are the similarities in their objectives and their concerns and priorities. And they're nearly identical around the world.
It's kind of shocking,
It
right?
is.
Yeah.
And we actually did a test, which I haven't emailed out yet. But it was who said it, Trump or Biden.
Oh, I love those sorts
Yeah,
of things.
yeah.
Great, because talking about checking bias.
I know. We're probably going to send it out next week.
Oh, that'd be great.
We're sending it out soon. But it's we took all the relevant sections around the world of their concerns and priorities and everywhere. And we have these quotes. And so far, the people that have taken it, they've gotten less than half right.
I'm not surprised, and I probably would too,
I know.
right? Like we all have our biases.
I
It's
know.
so natural.
But anyways, the one big theme is reindustrialization of our
Yep.
country. And so whether it's tariffs or not tariffs, when I hear people say in the business, tariffs are confusing, they don't know, if it's going to be around, should we be shoring up here or should we be doing something else? To me, is blatantly obvious, like don't fight the Fed.
Yeah.
Who's ever in charge, they are trying to bring more manufacturing back to our country, no matter who's in charge. It seems blatantly obvious to me. And it seems like there should be an effort to further that. But
Yeah, so let me take that on because this has been a really important trend for a couple of years. I mean, it really goes back to 2016 during Trump's first term. It was in 2018 that he first introduced tariffs that were largely directed at China. But that was essentially the first time in almost 100 years that we had increased tariffs. And then importantly, to your point, when Biden came in, he barely changed it. Right? So that was a moment where we're accepting both sides of the aisle. They're saying tariffs are a new policy that we're willing to take out of our toolbox. And I think that really marked a change in moving from this era where we're going to lower tariffs and barriers to trade at all costs. Now, the consequence of that was the offshoring of a lot of manufacturing. Now, there were benefits to that, right? Costs went down significantly. Services jobs went up more than manufacturing jobs went down. But it also meant that we had a lot less control over things. And then COVID was also a big wake-up call when supply chains got disrupted, and all of a sudden we realized that a huge proportion of the masks that we use in the U.S. are manufactured offshore, right? That's a problem.
That was a huge wake-up.
Yeah. And all sorts of like PPE equipment and whatnot. So there's also like a national security issue. A vast majority of our chips are built overseas, right? So I think there was a greater realization that there's advantages to owning more of that manufacturing, and so that led to some reindustrialization, nearshoring, also putting manufacturing facilities maybe outside the U.S. borders, but very close, so that it's easy to get to us. Now, here's the challenge of where we are right now. I think there's a growing realization that maybe we don't want to go as far as we had in terms of offshoring our manufacturing. So tariffs are one tool to be able to bring some of that back. The challenge that I think a lot of companies are facing today is the noise around tariffs. Companies are very good at adapting to different environments. COVID is a great example. But when you have a moving target, it's very hard to make long-term decisions. So one day your tariff's 10%, another day it's 30%, another day it's 5%. It's hard to like kind of do the math and be like, okay, now I'm going to commit $100 million to build a new factory, right? And so I think that's kind of some of the stop and start that we're seeing companies struggle with. The good news is that compared to when tariffs were first announced in April of 2025, there was this huge range of possibility to these extremely punitive rates that we saw on China to nothing, right? And the market was saying, oh my gosh, we're going to be anywhere in between that. Over the last 12 months, that range of options has narrowed. There's still not as much certainty as many companies would like, but it's narrowed. And so I think companies are in a better position today to start to make decisions than they were, say, a year ago. So to your original point of reindustrialization, I think over time that will happen. And I think we're also seeing other trading partners react to some of the things that we've done, and they're looking to onshore more manufacturing as well. And so I think this will definitely be a trend for a good number of years.
However, whatever the method, tariff or anything else, it just seems obvious that there will be resistance to having companies offshore from a government level. You know, they're just that is going to be something you're hit with.
That calculus
in one way,
has
shape,
changed.
or form. They're going to be resistant to seeing that happen.
Yeah, that calculus has for sure changed relative to like 10 years ago.
Well, cool. I think we've got this huge income disparity in our country, and I think some of that may be to blame. I don't know. It's hard to say, but.
I actually think if this is a topic that you want to dig into, I actually think it's a really interesting one. And like people talk about the K-shaped economy. This is actually something that started in the 1980s. So it goes back decades and decades where we see this like growing dispersion in income rates. And in general, when that happens and everyone's income is increasing, it's okay. Right? I'm okay with that guy getting super rich because I'm actually like a little bit better off than I was last year or 5 years ago. So most people were willing to accept that increasing dispersion because their standards of living were growing in general. That really changed during the global financial crisis, where you had the lower end consumer that got hit much more, right? Those were the folks who got stuck in these subprime mortgages, and then all of a sudden they're being thrown out of their homes, and then all of a sudden the labor market's really terrible, and they can't get back to the kind of same level of employment that they had. So that like lower end wage worker really struggled for years coming out of a global financial crisis. And I think that was when all of a sudden those income disparities become much more important. And I think that is a big driver of a lot of like the political changes that we've seen. And so now we have this idea of a K-shaped economy, but it's on top of decades of this already happening. And I like to share that simply because I think it highlights how difficult it is to undo. Because we're not just tweaking a direction over the last couple of years. We're talking about undoing decades of that happening. So, and the U.S. is not alone, by the way. This has happened all over the world, particularly the developed world, but the U.S. is one of the most extreme examples.
So I think in 1980-ish, the top 10% of taxpayers had, I want to say, I'll put this up to make sure if I have it wrong, I'll put a picture up. But I think it was like 35% of the income or something like that. And now they make up 50% of the income for the top 10% of taxpayers in the country. But that is also 70% of all the taxes paid. Neither one of those are healthy. At all. I don't think.
Well, we talk about a concentrated stock market.
I know.
This is a very concentrated economy.
And I think that the top 25% of taxpayer income, payers pay like 90% of the tax bill. That's not comfortable. Like if I ran a business and 90% of my income came from, 25 out of 100 places, like doesn't sound like a very stable business model to me.
Well, but you can look at it on both sides, right? The income is extremely lopsided, right? Where it's a very small percentage of people who are earning the income, and then it's a very small percentage of the people who are paying the taxes.
But even
so
more
both sides of that make it very uncomfortable.
So I don't know what the solution is.
I don't know either. This is a good reason why I'm not a politician.
I don't know.
I can read the numbers, but
I'm hoping that more manufacturing, I'm hoping, is something that can help.
Well, and it's interesting because I think a lot of people are conflating this idea of manufacturing resurgence and something like a living wage. So part of the reason why manufacturing jobs were so sought after and missed is because, number one, they existed in smaller communities that tended to be very dependent on like a couple of factories. But also you could have people who didn't need like extensive education, but instead had a skilled type of labor who were able to earn a really attractive income, have good health care, have a good pension, right? Think about like auto workers. Those were really sought after jobs for a really long period of time. And so if people were able to get those types of jobs and benefits, but in something other than manufacturing, I think they'd be happy, right?
Yeah.
They want to be able to feed their families and whatnot. So the question is, when those manufacturing jobs come back, are they going to offer that type of benefit and structure and longevity?
Yeah.
And I think that's still a question. We have to see if the experience of the workers actually improves with those manufacturing jobs coming back. And I'll just give a quick example. Like a lot of these new manufacturing facilities that are being built are largely robots. And so the people in that community won't necessarily get back to those jobs that they had a couple of decades ago. And so I think that's for the government to help manage. Are we actually getting the benefits of these new facilities and whatnot that we really wanted to?
Yeah. 40% of the taxpayers get money back, which seems crazy to me. And I don't say that to blame like they're doing something wrong. I think what that means is they don't make enough money.
Yeah. Yeah.
That's too much of our country that doesn't make enough money.
Yeah.
You don't even make enough money to technically have a net tax expense at the federal government level, and that's not a...
Yeah, and there's another stat that I'm not remembering the specific, but it's a very high percentage of people who are on food stamps who have 3 jobs.
Yeah.
Right? Like, this is not, like...
This isn't right.
There's got to be a better solution than that.
Yeah. Well, and I don't know what it was like in Texas. In Michigan, there was a big push that everybody that graduated from college graduate from high school had to be college ready. And we lost a lot of our trades. And we lost a lot of this stuff. And it got to a point where like it was almost a disappointment, or you were seen less than if you didn't go on to college. And then the graduation rate at college isn't all that great, by the way.
Meanwhile, people are taking out
national
huge
average.
student
So they go
loans
for a couple of years, 3 years, and they got loans.
Yeah.
And then they don't have that college job, and then...
That breaks my heart.
Yeah. So I think there is a change where it's being celebrated, not just to go to college, but to do other things as well.
Yes.
And
I find that it's really interesting because, again, I have 3 teenagers, so I'm thinking about this a lot as my oldest is applying to school. And I think we do need to have a cultural shift that embraces things like the trades more than what we have seen over the last few decades. And I think partly because this whole conundrum with college, families taking on way too much debt in order to send their kids to school and then risking dropout or being in roles that just aren't right for them.
Right.
And then meanwhile, I can't find a good plumber.
I know.
Right? Like we have real needs.
Yeah.
And then I'll throw in AI as well, because that tends to be one of the most common questions I get, particularly from parents who are worried that they're like whatever their kids are studying are not going to actually set them up well for a job. But I think we need to think about what are those types of skills that we're going to need in a post-AI world, and being a plumber is a pretty great skill.
It is, yeah. And so my youngest son, Owen, one of his good buddies, Cole, he didn't go to college. He wanted to be a firefighter his whole life.
Yeah.
And he went straight into that.
And thank goodness we have folks like him.
I know.
Like, that's amazing.
And he's making bank. He's filling up his 401k as a Roth.
Good for him.
And
hopefully he's talking with you.
Yeah, and he's watching Owen and his other friends that are still in school. They're not making money yet. And the power of, I mean, you get wealthy through how much you earn on your money, how much you sock away, and how much time you have. And how much time you have of those 3 is the most important one.
Hugely important.
And so, but from the age 20 to 26 or 30, you can buy 50% of your retirement bill.
It is
maybe even more.
Remarkable.
It's unbelievable.
Yes, it is remarkable.
Yeah.
And I think vastly underappreciated by a lot of folks.
Yeah.
But you can run the numbers, right?
Oh my gosh, it's incredible.
Yeah.
So and it's exciting to see some of this development happen. The celebration of something other than a college degree, I think, is just fine. So No, I asked you this question the other day because it was really interesting. What do you read? Remember we were
Yes.
yeah, I like that because we're consumed by noise all the time.
Yes.
So what do you read
Yeah.
that you find useful that is unbiased, or you can find information in it that isn't biased or helps you see where bias is maybe or something? I don't know.
Yeah, so I will warn you, I'm a huge reader. Both my parents were English teachers,
Yep.
so we acted out plays at the dinner table, and so when I want to curl up with something, it's a novel.
Yeah.
So that's like my sort of happy place, but just given my job, and again,
Yeah.
I love reading, so I spend much of my day at work reading as well. And so I usually have 4 or 5 different news outlets that I'll
Okay.
have up on my browser all day.
Okay.
And I'll make sure that it's kind of across the political spectrum,
Okay.
and it'll be U.S. and non-U.S. news. And so especially when there's a big story hitting, I'll quickly click through everything to kind of see who's reporting on what. And I think that alone is really interesting for showing bias,
Yep.
right? Like who's reporting on this particular event, and then you'll have other news outlets that completely ignore it.
Yeah.
And then you'll look at the Financial Times in the UK, and they have a very different spin on
Yeah.
it. So I find that really, really helpful. And then there's actually a new service called Ground News. I don't know if you've heard about it, but it's...
I did from you
Oh, you did?
yesterday.
Okay, good. So it's really cool.
Yeah.
You'll see, you can put in the topics that you're most interested in. And then when there's a particular headline about it, you can click on that and it'll show you kind of across the political spectrum what news outlets are reporting on it.
Okay.
And then each of those news outlets will be rated on what their bias is and their level of factuality.
Okay.
And again, they'll have non-US sources and stuff in there too. So
Okay.
I find that super interesting.
That would be. I've got some friends, we were talking about what people read, and they were saying they like to read the far right and the far left, or this is my right hand, far right and
Yeah.
far left. And I'm like, why? Why do you want to read the angry here and angry here? Like, why is that? That sounds horrible to me.
Yes.
Yeah, but so it's important to read both ends of the political spectrum, but I don't know that you need to be way out here all the time.
I'm
just
with
angry.
you. I'll
Like,
sometimes look
yeah.
at what the headlines are
Yeah.
to see, and also because I talk with people all over the country from
Yeah.
all different political stripes, and sometimes I'll be asked a question, I'll be like, what? Like what? I've
Yeah.
never even heard of that.
Yeah.
So I like to at least know what topics are being discussed.
Right.
But for me, and this is why I like the Ground News, I want the factuality.
Yeah.
I'm okay if you're biased one way or another, but don't lie to me.
Right.
I want to make sure that I'm getting
Yeah.
the facts when I go there.
Yeah, and I think having, I like having some foundation so I can understand where that bias
Yeah.
is.
Yeah.
It's hard to see sometimes, but if you got
Yes.
some foundation, then you can kind of see, oh, I can see what's going on. And maybe that's not bad. They're sharing a little bit of their opinion,
Yeah.
but it's good to understand where it is.
It's okay. Yeah, exactly. It's okay to have a bias. We're human.
Yeah.
I always say to be human is to be biased. We
Right.
just have to recognize what it is.
Yeah. All right, diversification. So I sometimes tell clients that diversification is the understanding that we're not perfectly intelligent.
Yes.
Right?
Yes.
So you can be extremely diversified, you can own a little bit of everything, or some type of rational diversification. So when you think of diversification, what do you think about?
Yeah, I mean, it's interesting you mentioned that because humility is actually a core value of my team that we talk about. So being able to recognize that you don't know everything, even a topic that you know deeply, there's still going to be stuff that you can't see or that you misunderstand. And so part of that leads to this idea of diversification. And then I'll say that the other sort of side to diversification is managing risk, right? Because diversification is a key tool for being able to manage that. And that's the reason why we don't go all in on a single stock. Because we can even understand the fundamental case perfectly, but the macro case might change, right?
Mm-hmm.
So I think being able to have that right balance between the amount of risk that you're taking on, the level of diversification, but to your point, not all diversification is good.
Mm-hmm.
You could own something that diversifies really well, in a very simple term, an asset class is diversifying when it moves differently from another asset class, right?
Okay.
So you think about stocks and bonds. Stocks and bonds can move in opposite directions.
Mm-hmm.
Sometimes they go in the same direction, but they're often moving in different directions. so that in an ideal world, when stocks go down, your bonds are kind of staying where they are, right? So that's the most common type of diversification that you'll see in a portfolio. But there is a risk to diversifying too much. So if you think about just this simple stock portfolio, if you own 1,000 names, you're just doing scattershot, right? And so your ability to outperform the benchmark
zero
is coming.
conviction.
Yeah, you have no conviction at all. If you own 5 names, that's going to be a very high level of risk relative to the benchmark. So you have to sort of determine within that band what's the right level of diversification, and then within that diversification, what's the right level of risk to be able to have. And so the answer might be a little bit different for every person, depending on like what their goals are and what their risks are. But I think as a practitioner who thinks a lot about portfolios, we're always kind of challenging ourselves to make sure that we're not having too much and not too little.
Okay. So you've got a pool, and it's modified based on what you're learning in the economics at the time.
Yeah, and maybe just to put a finer point on that, like if we think about, you might work with a client, you might determine that they should have this level of risk.
Right.
You and I might talk about, what that looks like in a portfolio, and we'll set up we call it a risk budget. So how much are we willing to insert risk into the portfolio, and how much are we willing to let it move around relative to the benchmark on a regular basis? And so we'll have really hard guardrails. We're not going to go outside this level of risk. But within there, we'll allow ourselves to be able to take bets. So we'll, see an opportunity and we'll go overweight that opportunity, but then we'll stop once we bump up against that guardrail. And that will also be a reflection of our level of conviction. If we like something a little bit, we might be a little bit overweight. If we like it a lot, we're going to go a lot overweight and right up to that guardrail. So there's the framework that you set up to begin with, and then there are the market conditions then that help you move within that framework.
Sometimes I hear somebody say, I'd like to be risky or really risky, or something. Add a little bit more risk. I think people sometimes assume if you add more risk, you're gonna make more money.
Well, it's got to be the right risk, first of all. Yeah, and then this sounds like the call that I often get from my mom on the way home from work. When the market's going up, she's like, I want to go all in, Kara.
Right.
And then the market's down, and she's like, I'm losing money.
Right.
So yes and no. In general, if you have a well-diversified, well-constructed portfolio and you put on more risk over the long term,
which means adding more equity, like
that's
bottom
the
line.
easiest way. Easiest way to add more risk is to add more equity.
Right.
Over the long term, chances are very high that your returns are going to be higher.
Right.
But over that long term, you might have this kind of up and down, right? So the challenge with risk is that it's not linear, right? Risk means that you're going to move around a lot kind of within this band. So, and that's where, to your point, like time is so important. If you know that you don't need this money for 20 years, go risk on, right? Because you have time on your side. As you get closer to that end point for where you actually need that money, you want to start to dial down that risk so that you can lower that returns.
I think some people think there's more to it than just adding more equity. Like I think they think, take this and put that in there, that there's something else that would add. Or maybe they're thinking about because there's cryptocurrency and there's other things that are so extreme out there. Maybe they're thinking about that as risk, adding risk. But are there things you don't add to the portfolio, like crypto or something like that? Are there things that you wouldn't add to a managed portfolio because
and we get asked about this
it's too
a lot.
undefined what the risk might be?
Yeah, so crypto is a good example, and then gold is another one that I get asked a lot about. And I always like to hedge it by saying I don't think that those belong in like a strategic portfolio.
Right.
That said, that doesn't mean that they're not going to go up. And I don't have a view really on whether or not those are going to go up or down. Crypto is a good example where we just don't have a lot of data. I'm a data junkie.
I think it's too hard to define.
Right, it's hard to define.
How do you measure what fair is?
Right, exactly. Even when I talk with like huge crypto bulls, I'm like, okay, tell me the circumstances under which crypto underperforms. Tell me how I can tell that it's overvalued.
Right.
And I get like blank stares. They're like, well, more people are going to use it. I'm like, okay.
Right.
So, and again, I'm not saying that it's going to go down.
Right.
It's just I can't evaluate it like a traditional asset class.
Yeah.
And then gold, we have a lot of history on, but the same challenges of not really being able to value it as an asset class.
Right.
And when we look at that, we do have data going back hundreds of years. And what you find is that gold has very long periods where it does nothing,
I know.
and then it'll shoot up.
Like-
and then it'll go back to doing nothing
Like
again.
for over a decade sometimes.
Over a decade,
Yeah.
yeah. And then,
Yeah.
and then over the last couple of years, it's just been a moonshot.
Right.
So, and I think often the things that cause gold to go on these moonshots are very hard to forecast. I can sort of explain
Yeah.
some of the reason why gold has been rallying, but then also recently you've seen this huge volatility in it
Yeah.
as well. That's not based on fundamentals, that's all on sentiment. So my preference is to keep it out of a strategic
Yeah.
portfolio, and then to guide people if they really want exposure to that, that's cool. Just like keep it small so that
Yeah.
it doesn't overwhelm your returns
It's a
elsewhere.
lot easier to evaluate and measure something that also creates income.
100%.
Yeah.
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 And, or there's a business attached to it,
Yeah.
right? Like.
Yep. All right. I got a couple more questions for you. Let's see. When do you think, in understanding the economy, where do you think that gives maybe people too much confidence and they make poor decisions? Or when they don't have enough basic understanding of what's going on? Like you said, there's some fundamentals like don't fight the Fed. You know what I mean? There's
Yeah,
some fundamentals.
yeah.
Where do you think where they don't have enough understanding what's going on, they also make bad decisions? Too informed or not informed enough?
Well,
or they think they're too informed.
So I think those often go hand in hand,
Okay.
ironically. You know, we were talking about recency bias beforehand, and there's been such an interesting area of academic study on behavioral finance, and this is another one where it tends to be that the less people know about a topic, the more confident they are. Right? Like, whoa, that sounds like a problem.
Okay.
And that's part of the reason why we have humility really built into what we do, because we all have this tendency to inflate our ability to do things. And so I'll give an example. Like 75% of all drivers think that they're above average.
Yeah, I love that one.
And I go on the highway every
And
day.
I'm one
and
of them too. I think I'm a damn good driver.
But then you look at everybody
And I-
else, you're like, they're
And
not
I think
good
I drive better
drivers.
than Chris does.
Yeah.
But she has less accidents and less tickets than I have.
see?
So I don't know. Yeah, by what measurement is better?
Yes. So I think it's important for people to understand economics. I think it's important to understand the drivers of what's happening in our economy. But just as humans, we also have to have this like natural understanding that there are great limitations to our ability to forecast what's happening in the economy.
Yeah.
And I think having a healthy balance of both is really important.
Yeah. Another one, I think this question, I already have it written down. Are investors better served by understanding the economy or understanding themselves?
Understanding themselves.
Yeah.
Again, because it's actually easier to like read a book and understand economics. Like I love that you sat down with the flow of funds data because you probably really understood it. But getting to know ourselves is a lot harder.
Yeah.
There's no manual for me.
Right.
Right?
Yeah.
I have to do it by making a lot of mistakes.
Yeah.
And I think that's where like having a financial advisor is such a huge help. I mean, obviously you have a huge amount of understanding about like markets and portfolios and financial planning, but also for you to provide that coaching, right, and reflect back on people. I think that is incredibly valuable because that is oftentimes the harder piece of it.
Yeah. So I tell people we get rich or we get wealthy by buying things that make us richer in small increments over the course of our life.
Yes.
And it doesn't just happen all of a sudden.
Yes.
We make it happen over very small increments over a long period of time. And too much information, I think, it can be motivating or sometimes it can be debilitating. And
Yes.
bottom line is, that's the beauty of the 401k, if you keep implementing every payroll,
Yeah.
regardless
Consistency.
of what's in the news,
Yeah.
over the course of your career,
Yeah.
you're going to be pretty well off.
Massive benefits. And,
Yeah.
and that, dollar cost averaging, this ability to put in X number of dollars every month, no matter which way the market is going, is an incredibly effective tool of growing wealth over time. but it's also difficult, right? That's a great example of something that sounds simple,
Yeah.
but most people have a very difficult time doing it, right? Because they overthink things or overconfident or whatever it might be. So having that like very systematic approach and just being regular about it is really the path to success. And I always say, like, just because something sounds simple doesn't mean it's easy to do. And that's the one of the more challenging parts about our business.
So I got maybe two more questions. One of them, I'm always fascinated by this. The stock market going down in value freaks people out. And if you're pre-retired, there's technically nothing better than that. I know we want to see our portfolio be worth more every month, but
Buy cheap.
technically it gives me a chance to buy shares I wish I bought a year ago.
Yeah.
That's actually a great opportunity.
Yeah.
If you're retired, obviously don't sell from that. Sell from something else to pay your bills,
Yeah.
and that'll come back. But the stock market depreciating in value or going down in value is one of the few sales in life that consumers tend to run away from. And it seems like everything else in life we celebrate when we get a good deal on it.
Right.
And I hear people say, I'll invest when things look better. But they don't look better until it got more expensive. What do you see in that dynamic of that human
and
dynamic?
This is like the huge paradox, and this is why you and I have jobs too. So when the market goes down, most people have a difficult time believing that things are going to come back.
Okay.
Because whatever has driven the market down has driven it down for a reason, right? Market participants are not stupid. So think about COVID. We have this massive global virus that is killing people. We can barely even test for it, forget about treat it. The market naturally went down.
Right.
But the market bottomed well before we had any sort of vaccine in sight.
Right.
It was when we started to be able to treat it and when the incremental news became a little bit less bad.
Yeah.
So people had to believe that things were going to be able to get better. And it's really hard for people to be able to see through that. You have to have a lot of faith that
That's
COVID's
a tough
going to be
one.
resolved.
A global pandemic.
Yeah. I
That
can,
tested me more than any other environment in my career so far.
I agree. That was the hardest part of my career. And, I went through the dot-com bust, global financial crisis, all of that. But COVID, I felt was the hardest.
And
because
thank
it was,
God I didn't change.
Right?
Oh my goodness.
I know. And I talked to so many people at that time. We were actually buying stocks into that. Because again, we have this discipline.
Yeah.
And when stocks drop by that much in a very short period of time, like you buy.
Right.
And so we were going in, we were managing a lot of client accounts at that time when we were buying stocks, and we were preparing all of this communication because we knew that we were going to get some angry phone calls. Like, how could you possibly put on risk at a time like this? And we happened to get the timing right. A lot of that was really just fortuitous. But then people who stepped out of that and said, no, I want to go to cash, I want to wait this out until it gets better, missed this massive run in the market. Yeah, and so those mistakes, even small mistakes in those types of environments, can be very, very costly to your outcome.
Yeah. Yep, it never is a straight line, is it?
No, and that's why it's so difficult.
Yeah. But it gives you those opportunities to buy things that you wish you would have bought a year ago.
If you have the discipline, right? And you studied this stuff enough that you know, but you have to be able to have that discipline. You have to do that despite the fear that you have.
Yeah. I've got one more question.
Yeah.
But before I ask it, is there anything else that you wanted to talk about?
No, I think we've covered tons of great stuff.
Awesome. Well, Kara, I do want to thank you for your financial education. You give me the courage to be resilient and to be disciplined and to diversify.
I love it. That's great.
With a lot of fun while I'm learning.
That's great.
So keep doing what you're doing, please.
Thank you,
it's
and
wonderful.
ditto.
Yeah.
Appreciate it.
Last question I have is the name of this podcast is
Wealth is a choice. Boom.
And most people, when I say the word wealth, they associate it with money.
Yeah.
But to me, it's abundance. It doesn't necessarily mean money. It could be health. It could be wealth. Not wealth. It could be fitness. It could be, family, religion, community, organization, whatever. So in whatever capacity it means to you at this moment, do you think that wealth is a choice?
So I'm gonna give a non-simple answer.
I love it. I didn't expect anything different from you.
So let's assume that we're not one of those people who are born into extreme poverty or with serious health issues from the beginning, right?
Right.
You're kind of like your average American who has access to like good education, like all those sorts of, like you check those kind of basic boxes. Then yes, I believe wealth is a choice. We don't suffer from a lack of understanding about what generally over time leads to good outcomes, whether it's growing your 401k or having relatively good health or having good relationships. Where we all fall down as humans tends to be in not executing on those things, right? So I know if I go to the gym twice a week and I go for a walk every day, I'm going to be stronger and I'm going to feel good.
Right.
Do I do that every week?
Okay.
No. And I'm thinking about I'm supposed to go to the gym this evening and I'm trying to get excited about it. So I know what I have to do,
right.
but it's still really hard to do. And I think like financial wealth is the same issue. You know, you mentioned starting early, adding to your 401k regularly, buying when stocks are down rather than selling. I can show you tons of data about how all of that works, but actually convincing people to do it on a regular basis is really, really difficult. So if you're going to choose to be wealthy in those ways, I can give you the roadmap.
Right.
Now go execute.
Okay. Yeah, I agree. It is, simple, not easy. I've heard that before.
Yes.
Yeah.
Yes.
Awesome. Well, thank you, Kara. I'm
Thank you.
honored to
I
have this
appreciate
time
it.
with you. I appreciate it.
It was great
Yeah,
to chat.
thank you very much.
Ta-da.